Welcome to Module 7 of Property Finance Investment. In this module we look at the rather tricky area of forecasting. One of the important things about applying a discounted cash flow analysis is that just about all the numbers you're dealing with are forecasts. Now, it's easy to get carried away with the mathematical precision and the computer elegance that you're able to build into a DCF model. But we need to sober ourselves by being very aware that just about every number in our DCF is a number which is in the future and is therefore risky, and it's a forecast. And in more aggressive times in the market, especially during boom times, when prices are rising and escalations look like they're going to continue at a very strong level up into the future, it's easy to get carried away into thinking that the world is always going to be like this, that, or the other. The boom is always going to continue. And that's part of what fuels property booms, especially it sort of drives them to the crazy heights immediately before you have property crashes. And so there's a psychology we have to avoid. And so as property economists, what we have to do is be able to step back and make sober forecasts. When the rest of the world is saying that nothing is going to get better, we have to be able to stand back and say, well, there's in fact considerable reason for optimism. Conversely, when the rest of the world is saying the good times are going to continue to roll, let's pay more for this property, and because we're going to make a bag of money on it in 6 or 12 months' time, we have to be able to stand back and say, well, that may have been happening for the last few years. However, it looks like there are fundamental factors that we need to consider that might be telling us to pull our horns in. So forecasting is really putting a reality check into the optimism or pessimism that otherwise drives market cycles. To look at forecasting, we're going to be looking at the nature of forecasting, at the various approaches that have been taken, but also to critically appraise how confident we really can be with forecasts and the various approaches that have been taken to researching the reliability of forecasts. We're also going to be looking at the rather tricky area of property cycles. Through your professional lives, you're going to be talking about property cycles quite a lot. However, when we look closely at them, we find that they're not actually cycles at all. Strictly speaking, they are semi-regular fluctuations. And you might say, well, what's the difference? Why are we bothering with words? Well, a cycle is something that a physicist might use to understand the harmonic motion of maybe the way electrons circulate around an atom or planets around a star. But the fluctuations that you find in the financial world are far less orderly, far less predictable. Many people would wish that at the time of the euphoria immediately before the recent global financial crisis, they had considered that fluctuations were a bit more random and chaotic than the regularity that they were expecting. So we're going to be looking at whether property cycles are really cycles or if they're something else. In particular, I have an exercise for you to build a chaos model. This is not a crazy model, which is normally what we think of as chaos. Chaos is a particular area of mathematics which has been growing in the last 20 years or so, maybe a bit more, because it's found to explain very well many phenomena that we find in both the physical and social world. And applying chaos theory to property markets and in fact the economy in general is proving to be a very fruitful area of research, even though to get the kind of answers and the predictions that we'd like in terms of improved forecasting isn't really quite so straightforward. One of the things that chaos theory appears to be telling us is that we can probably be confident that forecasting will never be something we'll be able to do, at least in the way that we do economics and finance, with any reliability. That is, chaos proves that forecasting will always be a very risky business. Now, if that's the case, that really puts paid to the idea that around the corner we're going to meet somebody or learn something which will enable us to see into the future and build DCF models which are very reliable, off 5, 10, 15, 20 years off into the future. I hope you enjoy this module. It's a very important one conceptually. It will probably be a bit of a test to see how well you can go out of your comfort zone as far as the familiar ideas that maybe you've come into the industry with. If you get your head fully around it, you'll probably find that you'll be looking at property and the future of the markets and so on in a slightly different way to many other practitioners. Whether or not you want to apply that learning or not is up to you, but certainly it should give you a resource to be able to weather the ups and downs of the property cycle a little bit better than many other people in the community, which after all will help you to make money when other people aren't and avoid going bankrupt when other people are. I hope you enjoy the opportunities that are in this module.